Odysseus captured the moon. The Yemen-backed militant group Houthis banned US and Western ships from entering the waters of the Red Sea. Odysseus was launched last Thursday on a Falcon 9 rocket, and today NASA announced its successful landing and the start of the mission. And the UK Maritime Trade Operations Authority reported yesterday another rocket attack on a ship off the coast of Yemen. Interestingly, both of these events, despite the diverse nature, have an impact on the stock market sentiment. By the way, Japan is not trading today on the occasion of a national holiday, the Imperator's birthday, and Asian and European stock markets spent February 23 on the rise. Futures for the SP500 index also logged growth. Risk sentiment is supported by tech stocks, with the Nvidia at the forefront. Investors are regaining the risk-on mood on the back of good economic statistics. While reports have been mixed this week, they generally support the market's view that the global outlook is improving. Germany's business climate indicator inched up to 85.5 in February. The region is in line with the market expectations. Meanwhile, the business confidence index in France over the same period rose 200 points from 98 a month earlier. Remarkably, Germany now occupies the third place in the list of world economic leaders. Therefore, its macroeconomic data have special weight for the European market, as long as reports in Europe and the United States confirm an improvement in the global prospects, and we will see an increase in stock indexes. Another important factor for the such forecast is the comments of central bank policymakers. The minutes of the ECB meeting in January, published yesterday, showed that the scenario of a rate cut was premature. Bundesbank Governor Joachim Nagel said on Friday that consumer prices will remain way above 2% in the coming months, and thus it's too early to cut interest rates, even though it seems tempting. At the same time, his colleague from the ECB, Isabel Schnabel, believes that the risks of a further monetary tightening have decreased. In the Eurozone, judging by futures on the ECB interest rate, traders are expecting 4 cuts of 25 basis points each this year. That's by 1% on the whole. At the end of last year, the size of the expected rate cuts were set much higher, by 1.75%. Evidence of a stronger inflation also dampened optimism about an early cut in the global interest rates. For example, in January, consumer expectations for the Eurozone inflation over the next 12 months rose to 3.3%, according to a survey by the ECB. However, in December, such expectations were 3.2% and recorded the lowest figure in the previous 10 months. There are no plans to reduce the official funds rate too quickly in the US either. Concerns about premature rate cuts have already been expressed by Fed policymakers, such as members of the rate-setting committee Lizzie Cook and Christopher Waller, as well as Vice Chairman Philip Jefferson. Jefferson also hopes for a soft landing on the American economy, but at the same time he is praised for the scenario that some unforeseen shock may occur. At the same time, the policymaker defined the January data on consumer inflation disappointing. According to Philip Jefferson, the fight against inflation may stall if consumer spending does not begin to fall. Considering that all US stock indexes closed the previous day with a strong growth over 1% and 3%, the rally in shares of the technology sector is going on. The general market barometer S&P 500 updated its historical high, having jumped by 2.11%. The index also opened higher on a Friday at about 5,080 points. It maintains its bullish momentum, so the index is on a track to close the trading week at a new record high, provided that investors retain the appetite for risk. Meanwhile, the yield on the benchmark 10-year Treasuries remains near its highest level since late November. As a rule, Treasuries steadily enable the US dollar strength. Moreover, on the back of mounting geopolitical risks, the tailwind for the American currency is only intensifying and thereby disabling the euro. Nevertheless, the single European currency finds drivers for growth based on a positive economic statistics. After business confidence data in France beat expectations, the euro jumped to a 20-day high of 1.0890. Comments from ECB officials moderated expectations for a quick reduction in global interest rates. Therefore, the euro-dollar pair retreated and consolidated around 1.0850. At the same time, the instrument maintained a net increase for the day. Moreover, the US dollar index, after a slight strengthening on early Friday, opened the American session already in the red zone at 103.80. Therefore, the euro-dollar pair can again test the area of 1.0865 and 1.0900 in the short term. But there are no preconditions in favor of any higher levels yet. Brent oil has been under selling pressure since yesterday. At the same time, the difference in the price between contracts from Brent and the American benchmark rate WTI was more than $5 per barrel. Oil prices $85 per barrel. The prices fell on Friday after the Federal Reserve said that the rate cuts should be delayed for at least another 2 months. At the same time, statistics showed that US crude oil inventories rose less than expected last week. Besides, refinery output could increase in the coming weeks. Let's not forget that oil prices are fueled by the conflict in the Middle East. Therefore, the Brent price rebounded today from the bottom around 82.20 and headed up for the resistance zone of 83 and 84. The nearest technical resistance is located around the round level of $82 per barrel. Considering that high interest rates from major central banks are stalling economic growth, this may lead to a decrease in the demand for crude oil. In turn, this may also be related to the fall in oil prices today. In addition, the situation in China's economy, the largest oil importer in the world, is increasingly alarming. Beijing's main headache for more than 2 years now has been the construction sector. New home prices in China fell by 0.7% in January from a year ago. Reports released today showed that January became the 7th month of a decline in a row and showed the sharpest drop since March 2023. The downtrend emerged due to the reduction in mortgage rates. Thus, the Chinese authorities want to revitalize the economy and mitigate the impact of a long-term downtrend in the real estate market. So you have watched the market review by InstaForex analyst for Friday, February 23. Subscribe to InstaForex TV channel and we keep you updated on the recent market developments. Don't miss our videos. Your feedback is appreciated. See you online next week.